Hello, everyone. Thank you so much for joining me tonight. I hope everyone had a wonderful holidays and a welcome to the new year, 2024. Can't believe I'm saying that. Uh, as always, I think I have a wonderful presentation for you tonight. We'll take a little deep dive into 2023. We're going to touch on politics, hence it's an election year. So we're going to go a little bit all over the place, and then I'll dive into what I think makes the most sense going forward. As always, you are more than welcome to raise your hand during the presentation. You'll see a little hand icon. So if you have a question, raise it at any time. Of course, at the end of the presentation, I'll stay on as long as you like and answer any questions you may have. Tonight, I'm going to start a little different. I think I'll utilize this going forward as well. I tend to read a decent amount, and a book I'm currently in love with is The Psychology of Money. It is a fantastic book, came out a few years ago. Morgan Housel was the author. I've been watching a lot of his podcasts. Frankly, uh, he has a lot of the same approach as me in terms of how to approach investing, in terms of staying logical, disciplined, structured, not letting your emotions kind of get the better of you. And I grabbed two lines from the book that I really think hit home. This he's actually quoting Napoleon. A genius is the man who can do the average thing when everyone else around him is losing his mind. Investing is a rather peculiar subject matter. And the reason I say that is, you know, if you had to do brain surgery and you were going against a brain surgeon who's been doing it for 20 years, unbelievable knowledge and experience, did all the studying, he's going to do it a million times better than you. You're not even going to be close. Same thing, Major League Baseball player. There's no way you're going to do any of it as well as him. He's literally spent all the time in the world studying his craft, eating, sleeping, drinking, everything to focus on his craft. Investing is rather incredible that you can have exposure to markets, leave them alone, don't touch them in good times and in bad, and stay disciplined. And you're going to probably beat 60, 70% of the investment professionals out there that consider themselves genius, unbelievable resources. The thing you want to do with investing is leave it alone. I think they say this about like your golf swing. The harder you try and swing, the worse it's going to be. The more you just do it naturally, leave it alone, the better off the results tend to be. Now, the second thing that I almost found rather unbelievable, or didn't really believe it at first, was out of Warren Buffett's current 84.5 billion net worth when he was writing the book, 81.5, so a $3 billion difference I'm sorry, I'm saying it wrong. 81.5 billion out of Warren Buffett's 84.5 billion net worth today came after he turned 65 years old. So 96% of his net worth came after he turned 65. Why do we know who Warren Buffett is? Well, we know him because he's one of the richest people in the world. He's been arguably the most successful investor ever. But 96 became after he's 65. So let's say he retired at a normal retirement age of 65, 67, even 70. We would have no idea who he was. He would have been a good investor, in some small circles, he would have been absolutely known, but no, not much different than anyone else. Well, why is he so special? What makes him different than anyone else? Yeah, he's smart and he's got a good brain for it. There's a lot of geniuses in the Wall Street and, kind of analyze portfolios. There's a lot of companies out there that have the same resources as Berkshire Hathaway does. The reason he is where he is he started investing when he was 16 years old. He's been in the stock market for 77 years. It's the power of compound interest and not touching your money. Now, one of the biggest things in going back to my first quote, it's not about, perfectly timing the market and, capturing Bitcoin at 1,000 and now it's 45. None of that. It's about not making the poor mistakes. It's not about making the emotional mistakes when things go are starting to go sideways and you freak out. Um, so I love those two parts of the book. Again, I would highly recommend everyone read it. And that was just a slight detour before my normal presentation. So hold on, let me pull up my slides. Okay. So let's start with the US stock market. Always a good place to start. Let me pull up my participants. So as we sit here today, last year was an unbelievable year, pretty much skyrocketing to us really close to all-time highs again, just kind of peaking over it, and now we're bouncing right around it. Now, just because stocks are at all-time highs, or even let's say they're down 20% or up 10%, doesn't really tell you if stocks are cheap or expensive. One of the main ways we're kind of analyzing this, and you could do this with a rental property as well, you're always comparing like what's the earnings or the rent versus the price I have to pay for it. And when you do this equation, this is your what's called your multiple right here. That's your PE multiple. Is you're dividing the price of the market. You can either divide it by the future earnings like we're seeing here. You could do the last year's earning or trailing 12 months, or you could do the last 10 years as an average. But what you're trying to do is get a multiple of what we're paying to own stocks. So as we sit here right now, we're paying about 19 and a half to be a participant in the stock market. All right. Is that good? Is that bad? Is that high? Is that low? So once we have that number, then we can compare it to 120 years of history and say, well, is this cheap? Is it expensive? Are we in a good spot? What should we do about it? So around 20, based on history, certainly on the expensive side. Now, this is the part why no one can time markets. Now, for the last 5 years, 20, 21, 22, 19, 18 has been average, has been normal, has been acceptable, and no one's really blinked an eye. So it's very hard, and this is why, you always hear the famous line, prior performance does not indicate future returns. Confidence in markets changes over time. Tolerance changes over time. What people are willing to spend on a building today is different from 10 years ago. It's going to be different 20 years from now. How much confidence people are migrating in certain areas. Same thing in the stock market. As we're paying about 20 times earnings, that doesn't mean run for the hills, markets are expensive, but it certainly is time to say, all right, markets are expensive. How are we in our financial plan? Do our goals look okay? Can we afford our lifestyle? Can we afford to take risk off the table and get a lower rate of return and accomplish our goals while stocks are expensive? These are all questions you want to be asking yourself. I'm a big believer in risk first. Understand the risk and then build your portfolio around it. I think people focus on return. I tend to focus on risk first. But as we sit here, stocks have off a little over 25% rate of return last year, and now bought expensive levels. Now, I was just giving you the history of the PE multiple. Now, history would tell you the multiple on average is around 16, 16 and a half. Like I said, we're about 19 and change. It doesn't mean a correct down to tomorrow. Like I said, it could be a couple years that we stay up here. That part we don't know. But it is a meaning of, hey, heightened caution, make sure we're not taking any more risk than we have to. With multiples going up this and stocks at all-time highs, what that tends to mean is when you look at your portfolio, and if you didn't look at it and you didn't tweak it, your exposure stocks have gotten bigger and bigger. And so maybe going into a downturn, you have more exposure to stocks than you want to. This is why it's a good time to kind of rebalance and take a look at the portfolio. Now, the overarching theme of what I just said is you can't time markets. You don't know exactly when what's going to play out. And this kind of slide kind of proves it. So over any 1 year, depending on whatever our multiple is, you get a pretty big spread of rates of return over the next year. So here we are sitting close to a 20 times earnings. Some years we've had really high returns, some years a little bit much lower. So it's kind of hard to gauge what's going to happen in 3 months or 6 months or in a year. But certainly as you go longer periods of time, the spread of returns becomes much more narrow. And this is what you're seeing here. the bottom axis, the lower the multiple we pay, the higher your future returns tend to be. Of course, the opposite is true, that the more expensive levels we have to pay, the more we've borrowed from future rates of return. So if I can go back a few slides real quick, an example is down here in 2009. So the whole world's pulling their hair out, freaking out. We're going through a financial crisis. No one wants to own stocks. Well, at the bottom of the financial crisis, you could have bought stocks with a 10 times multiple. And so if you were able to just not watch the news or pick up a newspaper and just see this one slide, and it's sitting here in 2009, you're saying, whoa, I get to buy stocks at a 10 times multiple. But when I look back at the last 110 years of history now, that's a pretty good entry point. And it was, because over the next bull market, stocks went up 400%. So again, I don't want to have people believe you can time get in and get out of the market, but in understanding of, hey, when we're at what could be a peak and what could be a valley, certainly take a look, make sure we're comfortable with the level of risk we're taking in a portfolio. Now, this goes back to the original quote about being able to do the average thing when people are losing their mind. Every single year, markets have something that can freak you out, whether it's North Korea doing something, oil spiking, the government raising interest rates. There's always something that scares you. So what this chart is showing you is what was the calendar year rates of returns. Those are in gray. And what was the intra year decline in the market that happened during that period. So for example, markets finished up 24% last year, but at some point last year, markets went down 10%. So if you're freaking out every time markets are taking a hiccup, you're missing most of the upside. If you leave it alone and you say discipline, you're going to be much, much better off than, people that are going to try and jump in and jump out. It's always difficult to predict when recessions are going to hit. Ask any economist in 2022, I would say probably out of the 100 top economists, maybe 98% of them predicted a recession in 2023. Recession never came. We actually had pretty good GDP growth. Unemployment stayed below 4%, and we actually had about a 5% GDP number in the third quarter. Not a bad year. Now, I always call this slide kind of the four horsemen of a recession. Typically, one of these are in a bubble that bursts, causing a recession. What we're looking at here is housing starts. The bottom left is vehicle sales. The top right is fixed investments, and the such as like investment in factories and things of that nature. And then the bottom right is inventories. As you can tell with the blue dotted line, it's kind of the average. They're all flirting right around average, maybe plus or minus a little bit. The hard part, the hard part about predicting a recession is when everyone predicts it, it's kind of hard for it to come. What did I just say about this slide? What happens is typically a bubble gets bursted. If we look at the top left one here, you have this big spike around 2007. That was housing starts. Who would have thought we had a housing bubble burst in 2008 and it pulled the whole market down with it? So if nothing here is at a crazy level, and all the CEOs around the country have been told that a recession's coming, no one's doing things that are bubble-like stuff, like being overconfident, overspending, spending huge on research and development. None of it's happening because everyone knows to be prudent right now because everyone thinks the recession's coming. So the economy right now is going okay. Nothing is really signaling to me that there's a imminent recession right down the pipeline. We're going to go through a few slides on the unemployment number, the jobs posting, but between that combination as well as these slides here, everything is going relatively okay. Now, as I say that, one of the kind of two longer term things that is always concerning to me, but it's always been concerning to a lot of people for probably 60, 70 years. Our debt as a country is certainly a scary thing. We're flirting around I don't know the number today, 33, 34 trillion dollars in debt. That's a humongous number. That's obviously ballooned a lot since COVID. Um, and now it's gotten a lot scarier because it's also a big number with a big interest rate. So, probably one of the most foolish moves in hindsight, easier to do in the rearview mirror, is for the last 10 years, the government could have locked in rates or the majority of their debt in 10, 20, 30, probably 40, 50-year debt they could have got away with. Because the people and the governments around the world and institutions around the world were buying our treasuries. Well, now, instead of paying 1 to 2% for 10-year treasury bonds, our government has to borrow at between 4 and 5%. Well, now we've had the biggest number we ever have in history, 33, 34 trillion, and now it has a big interest rate associated, at least compared to the last 15 years. So as our bottom right is our debt's going to kind of skyrocket because we're borrowing at bigger and bigger paces. That's a little bit of fiscal responsibility over in Washington. And the debt we've already borrowed is getting harder and harder interest rates. The music's playing. People are buying our debt. That could go on for 100 years, 50 years, or stop tomorrow. Whoever says they know the answer to that is lying. My opinion is, part of the reason we continue to be able to afford our lifestyle as a nation, where we're, to give you an example, to bring it personally, let's say you're spending 100,000 a year, but you're only taking in 72,000. That's what more or less our country is doing every year and will continue to do until more or less we can't. There is no other game in town currently. China is certainly developing, but has a ways to go in terms of our rule of law, in terms of a fundamental belief in how our capitalist structure works. I'd like to think that they're probably decades away from really competing us on that front. Europe has its problems. Japan has debt problems out the wazoo. So it's kind of like we're the cleanest of the dirty shirts. But, anytime you're surpassing 100% of your debt compared to your GDP, it's a little bit of a scary sign. Hence what we're crossing around sooner rather than later, and then continue to skyrocket from there. Couple takeaways from that is, when the government prints money, what are they doing? They're diluting the currency. So when you dilute the currency, what we've experienced in the last 4 or 5 years dealing with COVID, government prints $7, $8 trillion, dilutes the value of the dollar. What goes up like crazy? Assets. You saw home values go through the roof. Stock prices go up. Commodity prices go up. Real assets tend to do well over time, especially in an inflationary environment. Sadly, people think, oh, it's scary, the inflation's coming, I'm going to put it in the bank and put it in cash. It's not going to work over the long term. It certainly will give you peace of mind from market volatility in the short run. But, a saying I always have said for a long time now, over the last 100 years, the value of the dollar has lost about 96% of its value. The only loser over time is cash. I don't care if you want to own gold, bonds, stocks, real estate, hold any asset. I'm not saying you don't need some cash, but it should be a mix. It's certainly not the savior over time. So I told you about the one thing that scares me kind of long term, our national debt. And the second one is, I don't know exactly the solution to it, but the divide of the haves and the have-nots. So, even going back to 5, 10 years ago, you hear about the 1% versus the other 99%. Like I said, the haves and the have-nots have actually gotten much further since all those conversations started. So since, let's say we're in 2019 or 2018, if you were in stocks, you did great. Half the country doesn't own stocks. If you owned a house, it was great because house value goes up. I don't know the percentage that owns a house, but I'm sure a huge percentage that doesn't. So since that time, you saw milk, food, rent, those prices go through the roof. You've seen it become harder to buy a house much more expensive to get a mortgage. So if you're just starting your career in your 20s and 30s, this is a really tough gig. If you've already established and you have money in the bank and you have money in savings and you have money in real estate, you got to enjoy all the inflation. This was kind of nice. Your net worth went up dramatically over this period of time. So you always get nervous when you look back at history when the top 1-2% control a bigger and bigger percentage over time. And sometimes there tends to be a tipping point. No one knows how that looks. Again, that's another one of those scenarios. It could be a problem in a year, it could be a problem in 100 years. But these are two, I think, big concerns of our time. Nothing that I'm telling you to change quarterly with your portfolios, but I always just like to bring them up. So this is something I was harping on when we originally had the downturn during COVID. You know, COVID was an especially scary time, and even 2022 was an especially scary time because 2022 was painful because no one was spared. It didn't make a difference if you're conservative, aggressive, international, or a U.S. investor. Everything went down in tandem. Bonds went down 13%, and their worst year before that in the last like 50 years was down 3. So unbelievable, painful. People felt like it was the worst experience because what we're looking at here, the consumer confidence, how people feel about the stock market, how people feel about the economy. It was actually the worst on record, including 2008, where we had 10% unemployment. So it was a very scary time because you saw your investments go down, you saw your mortgage rates possibly go up, and you see your food and gas prices go through the roof. So I get psychologically why everyone was certainly miserable. But when people are upset and people, don't have confidence, it's tend to be a great time to invest. So every time when people feel blue, look all the points below this average line, it's a fantastic time to invest. So anytime you're saying you're looking at something and you're upset and you want to shoot me an email or give me a call, I want to get out, this is frustrating the heck out of me. It's probably when I'm going around maybe in my personal investments saying, well, now's the time to invest because the average investor is now upset. Hence, its markets will probably go up from here. There's a point, what's called capitulation, where people just say, I've had enough, I want to get out. And that's typically when you want to go in. So when consumer confidence is down, it's typically a fantastic time to buy for stocks. So you had a couple very nice windows. COVID, on the bottom, markets went up 43%. We had the pain of last year, 2022, and since then we've rallied 17%. Again, the overarching theme is discipline and leave it alone. Understand the money I might need in the next 1, 2, 3 years. Of course, that should be a completely different level of risk. Maybe you have zero exposure to the stock and bond market, but everything else, you're more long-term investing, staying calm and not making mistakes rather than timing things perfectly is going to yield you the much better return kind of moving forward. This is touching upon how the economy is doing. Like a few slides ago, I brought up the kind of what I call the 4 horsemen of a recession. This is, well, let's call it the 5th. These are job posting. It's kind of hard to have a recession if you have 8.7 million job posted. There's only 6 million people looking for work. That means there's more jobs available than there are people looking for work. That's never really happened in history besides the last year or two. So companies are still doing okay. So it's a little bit of a scenario where everyone's so spooked by a recession that they prepared for it, and we might skirt by without one. So as we sit here right now, economy's going okay. Excuse me. The slide that probably got the most attention in 2022 was inflation. Of course, when inflation's hitting you in the face like it was between egg prices and gas prices at $5.50, still can't believe that. Obviously it's going to be the topic of conversation. So at its peak, inflation topped out at a little over 9%. And now we're getting pretty close to the Federal Reserve's goal of between 2 and 3%. We've been bouncing around in the threes. Now, a lot of this is due to housing. Housing's a little funny in how they actually record it within the inflation numbers. They do more or less a survey and more or less ask people what they think their house will rent for. And when you do it that way, It tends to be a lagging indicator on the way up, but it's kind of dragging a feet indicator on the way down. So really, and there's a lot of ways to analyze inflation. It's probably actually at 1-2% already when you factor in how they think about inflation. If you did it just based on rent prices have already started coming down. So as we sit here today, inflation is currently where we want it to be. Now, that also happened in the 70s, and the Federal Reserve inflation came down. And so the Federal Reserve lowered interest rates, and then it spiked back up again. The Federal Reserve is very aware of that today. So I would not be surprised if they wouldn't sacrifice a little bit of economic activity by leaving interest rates a little bit higher for longer to make sure inflation doesn't have a double dip. Because when it happened in the 70s, we more or less lost 15 years of economic activity because we all just dealt with inflation in a horrible, horrible way. So as of right now, they seem to be able to accomplish what Wall Street has termed a soft landing, where inflation has come down because the government raised interest rates, but it didn't trigger a recession. If we could pull that off, that'd be fantastic. It really has only happened once in history, and that was kind of in the early 90s under Alan Greenspan. But so far, so good. So what did this do to bonds? So as we sit here, what we're looking at here is the federal funds rate. This is a slide that I go over all the time in my reviews. Interest rates skyrocketed to try and get inflation under wraps, and they more or less have plateaued for, let's call it about 6-7 months now, in the mid fives. So what we're looking at here is what Wall Street believes is going to happen, what Main Street is going to, no, I'm sorry, Wall Street and the government think are going to happen. I think interest rates are going to come back down and then kind of plateau. That'll be nice if it happens. Time will tell. But this is a situation where, what people were running to is money markets and short-term CDs. And so the banks, what they were doing was say, oh, a 5-year CD is going to pay you, 4.5%, but a 1-year pays you 5, because they're betting interest rates are going to go back down. So they were trying to push you into shorter duration bond or shorter duration CDs. This way, when you go to renew, it's probably at lower rates. So I have a healthy amount of intermediate bonds in there because you want to capture interest rates going down, which I'll go over in the next slide. But you're going to start to see money markets maybe of a month or two were yielding 5.25, maybe 5.5, starting to come down. Because it was about 2 months ago, a 10-year government bond was yielding 5. Now it's yielding 4.1. As assumptions about inflation comes down and assumptions about the Fed's lowering rates in the future, so interest rates go down and all those money markets and kind of CD rates will start to go down as well. Now in the bond market, we get a little pop from that transaction. So we're just going to go over the chart on the right, focusing on the blue. So let's say the US aggregate is kind of the bond index. What we're seeing here is the impact of a 1% rise or fall. So rise is here on the gray, fall is here on the blue. So when we have a scenario like I was just saying, where a 10-year government bond yields 5, and then interest rates go down, so now they're only yielding 4, well, the older bonds that were paying 5 are worth more money. So as interest rates go down, value of bonds go up. So a 1% decline in interest rates around the country would represent about a 10.8% rate of return for the bond index. So how is that made up? That's made up of some of the bonds appreciated in value, plus you collected your, let's call it 4 or 5% in interest. So, longer term bonds and interest rates going down is where you want to be. You don't want to be in the shorter term stuff. You want to be in the longer term stuff. So you can easily see that comparison in the 10-year government bond versus the 30-year. So imagine being in a 30-year government bond, a 1% drop, and your bonds made an extra 20% rate of return that year. Because think about it, you're getting a much better deal for a longer period of time. And the same reverse played out in the last few years. Let's say you went back 3-4 years ago and you locked yourself into a 5 or 10-year CD paying you 1%. Well, if you try to sell it to anyone else and you're stuck paying 1%, now everyone could go get one paying 5, you would have to lower its price a lot before anyone would be willing to buy it from you. This slide's going over international stocks compared to the US. So what we've seen over the last 15 years has been tremendous outperformance by US stocks. So this is why I was mentioning earlier in the conversation, especially a lot of do-it-yourselfers, they get a recency bias. So they pile into US stocks and the large US stocks and the growth stocks and then just the technology stocks. And then things tend to regress back to a mean. So over the last 15 years, let me go back, sorry. US stocks have done about 14%, and investments around the world in the equities market or stock markets have done about half that. Now, this is very common when you look back at history. Markets tend to ebb and flow. So when you look back at history, this slide is going over periods of time where US outperform versus when international outperforms. So we just went through the longest and biggest stretch in the history of this country of outperforming international stocks. Now, internationals also had their time to shine. So really the 2000s were great for international. The 90s were great for us. The 80s were great for them. So we probably just entered a period of time where international is going to start outperforming. They're trading at much cheaper multiples. Like I mentioned at the very beginning, we're trading at about a 20 times multiple. They're trading between, let's say, 11 and 13 times multiple, much cheaper than us. And their dividends are yielding about 3% when ours are yielding about 1.5%. So you get paid much more interest or dividends to be over there, and you get to buy much cheaper. But people don't tend to move until it kind of hits you in the face. But this is, again, why we say disciplined, rebalance, and stay diversified. Now, one of my favorite slides, and kind of goes back to the overarching theme of this presentation, is if you just leave it alone, most of the time you're in fantastic shape. So this is going for rates of returns between 1950 and through 2023, a stock portfolio and bond portfolio in a 60-40. Now, everyone on this call is in at least some mix fairly close to 60-40, maybe someone's 40-60 or 70-30, but everyone is somewhere in the middle. Now, of course, over any 1 year period of time, you could have a bad year. You know, if it went up all the time, everyone would just simply put all their money in it. So stocks can, of course, hit you in the face. Bonds last year, tremendously painful. Bonds, what we're looking at here was actually last year for bonds is down 13%. But if you see something that's kind of interesting, over any 5 year period, this area in the gray, which is let's call it a balanced portfolio or 60-40, it's never lost money in that almost 75-year period of time. If you just left it alone for 5 years, you didn't lose it. So this is why I was saying early in the presentation, yes, you certainly should have your, let's call it 1, 2, 3 year money in a very low risk, easily accessible, very liquid, very safe. But your 5, 10, 15, 20-year long-term retirement money, there is no better game in town than the stock and bond market. As long as you can stay calm, leave it alone, understand this is a long-term philosophy, stocks and bonds have rewarded you with a beautiful rate of return in the long run. So your average rate of return from 1950 to 2023 in a 60-40 portfolio was a little over 9%. Do I think it's going to average 9% over the next decade? No. The reason I said was if we go back to those US stock slides, stocks are pretty expensive, so we'll have a little bit more muted returns. But international is cheap, and bonds are giving us a nice, healthy rate of return. I still think it's going to be a nice little return, somewhere in your mid-single digits, but probably not in your upper single digits or double digits. Now, one slide that I try to stay away from as much as possible, but it is an election year, or actually 2 slides. People tend to get very worked up around elections. I understand it. A lot of people's beliefs are very tied to them. They get very emotional around it. I get it. What people seem to not realize is, you know, McDonald's sells cheeseburgers if a Republican's in office, if a Democrat's in office. Home Depot's going to sell you a shovel if you have a divided government or it's all one part. It's not really material to them. I would argue corporate America has a pretty good pulse on DC. They can manipulate their reality pretty well. Now, what the everyday consumer goes through, or the everyday individual, this is again the Consumer Confidence Index. And let's just follow a Republican going through the different political presidential world. You know, as Bush was president, their confidence was high. Oh, Obama gets in, the confidence is the worst. Oh, Trump is in. Oh, the confidence goes way up. Oh, Biden's in. It goes to the worst one. Over time, this is a fantastic slide. This is our GDP, or how well we're doing as a country overall in terms of an economy. And this is the stock market. Under Republicans, the economy has averaged 2.8 in terms of a GDP. Under Democrats, 4%. And under a divided government, 2.7. Would I take 2.8? Absolutely. Would I take 4? Fantastic. Would I take 2.7? Sure thing. It's not quite the on switch, off switch that people make it out to be. The economy, yes, it can get influenced by politics. I think if a president um, who has a Congress that's also his political party can sometimes make a economy that's a B, maybe a B plus, or maybe if he does things that put more restrictions or more environmental protections in place, maybe take a B to a B minus, but it's not quite the A or F scenario everyone wants to make it out to be. So, and then the same thing with stock market returns. It's kind of interesting that the economy seems to do a little bit better under Democrats, but the stock market seems to do a little bit better under Republicans, pulling it around 12.9 as an average. Under Democrats, 9.9, and under divided government, 7.9. Again, all three GDPs, I'll be happy to take. All three stock market returns, I'll be happy to take. At least when it comes to your money and long-term thinking, you should really unplug the two. I already know come day one after the election, no matter who wins, someone based on their own political belief is going to say, get me out of the market. Normally a horrible thing to do. So again, stay calm, stay rational. Markets have been around for hundreds of years, kind of US wide, they'll continue to be here. Same thing with corporations. Just relaxed, stay calm. So in saying that, I will see if there's any questions. Well, fair enough. Everyone, of course, has my phone number, has my email address. If something pops into your head later tonight, always feel free to shoot me a call. Always happy to have a conversation. But I truly appreciate everyone joining tonight. This looks to be actually one of my more attended webinars, so I do appreciate that. Thank you so much, and I hope everyone has a wonderful night.